So question 2. Bolero PLC has compiled the following information on its financing cost. They have type of financing, the book value, the market value, and the cost of finance. So they've got 3 different types of financing. One is long-term debt. They have short-term debt and then ordinary shares. So you see that in this case, debt is categorized into 2, short-term and long-term. And each source of debt has got different costs associated with it. And so we cannot simply add the 2 and use it to say that debt is debt. Debt is not debt, given that they do not have the same maturity period and they do not have the same cost. So we treat each individually. Now, if you remember when we're talking about weighted average cost of capital, we said that the weight of every source of capital represents the percentage of the source of capital in our total capital. And this weight can be determined either from book values. We go to our balance sheet and the values of these sources of capital there, we select it as our basis for weighting. Or we can do so through market values, where we said that with market values, you simply go to the market and find out how much is the security or the source of financing currently being traded, and use that as the basis to weight your capital. Or the third type is where we said that we can determine the weight based on some target capital structure. Okay, so you may have a certain target capital structure that you want to achieve, a certain debt to equity ratio that you want to achieve as a business. So you can use that to work out the weights of each sources of capital. So question 8.
Kingsley,
Yes.
please, can you kindly go by?
Oh no, these are things we have already done. So if you check the old videos, there I'm just recapping it. Okay.
Oh, no problem.
So the company is in the 28% tax bracket and has a target debt to equity ratio of 60%. The target short-term debt or long-term debt ratio is 20%. A. What is the company's weighted average cost of capital using book value weights? B. What is the company's weighted average cost of capital using market value weights? C. What is the company's weighted average cost of capital using target capital structure? And what's the difference between the WACs, which is the correct WACC to use for project evaluation? So this is very easy and simple. If you have to calculate WACC using the book value weight, see the second column after type of financing is the book values. So that's what we're going to use. If it's market value weight, we use the third column. The one that is a bit challenging is the C, the target capital structure, because the question gives you a target debt to equity ratio, and it gives you target short-term debt to long-term debt ratio. So these ones, you need to use this information to calculate your capital structure before you use that to compute your weighted average cost of capital. Okay. I'm going to use the whiteboard. So please get your question so that we can all refer to it. Okay. So we have A. Weighted average cost of capital using book value. But we said that WACC can be computed as a value of equity over equity plus. So you have to always look at the capital structure. So now we have equity plus what? Short-term debt plus long-term debt. Okay. Times your cost of equity plus short-term debt over equity plus short-term debt plus long-term debt times cost of short-term debt. And because it is debt, interest on debt is tax deductible. So times 1 minus T plus long-term debt over equity plus short-term debt plus long-term debt times cost of long-term debt is also debt, so times 1 minus T. So that is our WACC, how we're going to compute our WACC. And this is no different. So that is why I always say that you shouldn't learn how to answer a question, but you should understand that if I have to calculate WACC, I need a weight, and I multiply that weight by the cost of capital plus the next source of capital, the weight. And the weight is basically the percentage of that particular source of capital in the total capital, which means is the ratio of the value of the security over the total capital. So then you go and find out, what is my total capital? What is my total capital made up of? In this question, our total capital is made up of ordinary equity, short-term debt, and long-term debt. So that's what you are adding together to get your total capital. So if I want proportion of ordinary equity, then is the value of ordinary equity divided by total. Okay, so you shouldn't learn WACC to be, okay, WACC is equity over equity plus debt plus preference share. So always that's what you are looking out for. No. If you have to calculate WACC, your question you are asking first is, what is the source of capital? It's not always equity plus debt plus preference share. It can change. So you should take note of that. So using book value, what is the book value of ordinary equity?
It's 2,000. 6,000.
6 million.
6 million.
6 million.
Yes, please.
So please, does it mean that the RE is the value of equity and the E is the percentage of equity?
No. E is
So
the value of equity. RE is cost of equity.
okay. So how do you get the percentage of equity? That one is given in the question.
Yeah, so the
Or how?
percentage is, that's what I'm saying. The percentage is the value of the source of capital over total capital.
Oh, okay.
Yes.
Okay. Total capital, which is the long-term debt, short-term debt, and the equity.
Right.
Okay. Thank
Okay. So the value of equity we said is 6 million over what is the total capital?
17 million.
17 million times cost of equity. What's the cost of equity?
14.
0.145 plus value of short-term debt. What's the value of short-term debt?
8 million.
Are you sure?
Short term.
9
Sorry,
million.
It's
9 million.
9 million.
9 million.
So 9 million over 17 million times cost of short-term debt,
6.8%.
6.8%, 0.068 times 1 minus, what's the tax rate?
It's 28%.
28%.
0.28. Then plus long-term debt. What's the value of long-term debt?
2 million.
2 million.
2 million over 17 million times cost of long-term debt 0.035 times 1 minus 0.28. So that is how you compute your work. What would that give us?
Nine point 13%. 13%.
Are you sure? Please, someone should confirm that.
Oh, okay. No, it's wrong. It's wrong. So,
Okay.
So I have 0.0800%.
Okay. 0.08.
00. No, 01. That would be 01. There is a 6 after the last 0. So 0.0801.
Okay. So that's about 8.01%.
Okay, I also had the same thing.
Yes, that's correct. All right. The next one be what using market values. So our work is going to be equal to, what's the market value of ordinary equity?
22 million.
22 million over total value is
32 million.
32 million times cost of ordinary equity 0.145 plus short-term debt
8 million.
8 million over 32 32 million
32.
times 0.068 times 1 minus 0.28 plus 2 million over 32 million times 0.035 times 1 minus 0.28. So that is your work based on market value. What do we have?
Please enhance 0.1135.
Okay. All right. Any question? Okay. And let's look at C. As for C, please, yes.
Please, would you always be giving the cost, or sometimes you have to calculate the cost yourself?
Oh, yeah, sometimes you have to calculate the cost yourself, and we know how to calculate it. Like the first question,
Yeah.
we had to compute the cost.
Okay.
Yeah.
Thank you.
Welcome. So this one, please, you have to really follow me. It's more of algebraic. So if your algebraic expression is weak, please just follow and pay attention as we do our change of subject and what have you. Because from the C, they say we should use the target capital structure, right? Are you with me?
Yeah.
Good. So now, using target capital structure, what was the target capital structure?
%60.
They said they want to achieve debt to equity of 60%, and they also want to achieve short-term debt to long-term debt of what? 20%. Is that not so?
Yes.
Good. So these are not weightings. These are just expressing one source of financing as a percentage of the other. So we simply are going to use this to determine the weightings. You and I know that from WACC, we said WACC is computed as the weight of the source of capital times cost of capital. And the weight here is the value of the source of capital divided by the value plus other sources of capital all combined. That gives you the weight. So if I know that debt to equity ratio, which is essentially D over E, is equal to 60%, then based on this, if I am looking for the weight of equity should be equal to what? The value of equity over equity plus debt. Is that not so?
Yes.
All right? Because my debt is short term plus long term. So I can just put there as D, debt. And this gives me the weight of equity. So, given D over E to be equal to 0.6, which is 60%, I can make D the subject by cross multiplying and say that D is equal to 0.6 E. Are you all following up to this point?
Yes.
Yes, sir.
Please, if you are not getting it, ask before I get to an afo. You come and ask, how did you get this? And that's why I'm taking my time. Up to this point, if you're okay with it, then we can proceed. We're going to do a lot of mathematics, small mathematics. Good. So if we are okay up to this point, then if the weight of equity, which is here, is equal to equity over equity plus debt, then wherever I see debt in this, I can put 0.6 E, isn't it?
Yes.
So my weight of equity, WE, should be equal to E over E plus debt, which debt is now 0.6 E. Is that okay?
Yes, sir.
Mhm. Good. So if that is okay with you, or let's simplify that. So this can further be equal to what? E over E plus 0.6 E will give you what? Remember
1
this
point,
one? 1 point,
0.7.
1.6E.
1.6.
Yeah.
Yes, because this E has a coefficient of 1. So you add that 1 to 0.6. So it will give you 1.6 E. That's correct. I mean, the weight has to be in values, not in figures. Sorry, not in alphabets. So I can cancel out E in this to say that E goes here and 1, E goes here, 1. So this means that I have 1 over 1.6, correct?
Sir, please, you change the color. I can barely see.
Change it to cancel out.
Ah.
Okay, so if we cancel, then we are left with 1 over 1.6. Is that okay? E cancels E up and down. So you're left with 1.6. What is 1.6 in decimals?
0.625.
0.625. So this is the weight of equity in our total capital. So if you have to calculate WACC, in place of all of this, you put 0.625. That is the weight of equity.
Hello, sir.
Hello, sir.
Please, I have a suggestion.
Yeah, go on.
So they give us the debt to equity ratio. I don't know if you can also do it the way I'm suggesting.
Mhm.
They give us debt to equity, which means the debt is 60. So if debt is 60, then equity is 100 based on the ratio, 60%.
Yeah.
So for us to get the weight, it means that the D plus the E will be 160.
Mm-hmm.
So then we have equity to be 100 and then the debt to be 60. So to get the weight, it will be 100 plus the 60. We will still arrive at the 1.6, 1 over 1.6.
Yes. So if you want the weight of equity, is going to be 100 over 160.
Yes, sir.
Yes. It works perfectly. Okay. It really works. But this is the mathematical intuition, the finance intuition of what you just said. Now, what you said
Okay.
in English. Yes.
Okay, sir. Thank you.
Yeah, so I believe you all heard what he said. Okay,
Yes.
you are giving that equity ratio of 60%. And debt to equity ratio is basically debt expressed as a percentage of equity. So if that is 60%, then means your total equity, so you can say that debt is 60 and your equity is 160. Okay. So if you express that, it gives you that. So that's the English. But in finance and mathematical intuition of that, you need to show this kind of computation. And if you see the past question, anytime this question had come, this particular one is worth 9 marks. The first two had 3, but this particular one is 9. And because of these things you need to do, you have to determine your own weight before you calculate the what. Good. So if we know this, then we can proceed. Our total capital, which is made up of debt and equity, if we sum the two, should always be equal to 1 or 100%, isn't it? So what I mean is the weight of equity plus weight of debt is equal to 1. Is that not so? Or 100%?
Yes.
That's the total capital that you got. Your total capital is equal to the percentage of equity plus percentage of debt. If you put together, it gives you 100%. So from what we've done so far, we have found weight of equity to be 0.625. And so we can base on that to find weight of debt. So we can say that 0.625 plus weight of debt is equal to 1. So weight of debt should therefore be equal to 1 minus 0.625. And that is
375.
0.375. Okay, very easy. But you and I know that this is not what we are interested in, because debt is further categorized into short-term and long-term. So we need to share this 0.375 among short-term and long-term. Okay? So we have to work that out. That's STD plus LTD is equal to total debt. From the question, we are also told that STD over LTD is equal to 20%, right? So I can say that STD is equal to 0.2 LTD. Are you okay up to this point? Yes, you are.
Yeah, please go back there, please.
Oh, yes, so
Long-term cost.
your
Total.
short-term debt plus long-term debt is equal to total debt.
Okay.
And the question gave you that short-term debt to long-term debt is 20%. So we have short-term debt over long-term debt to be equal to 0.2. If we cross multiply, then we have short-term debt to be equal to 0.2 long-term debt. So the percentage of long-term debt in our total capital will be equal to, so LTD in our total debt, LTD should be equal to LTD over STD plus LTD. So this is the percentage of long-term debt in total debt. And if we do that, that should give us 1 over 1.2. And what will that give us?
0.833.
0.833. So now if I want the weight of long-term debt in total capital, then that's going to be 0.833 times the value of debt, which we found here to be 0.375. And what would that give us?
Zero point 315.
0.312.
0.3125.
Yes.
Okay, so then weight of short-term debt should be equal to 0.375 minus 0.3125. And that should give us
0.0625.
0.0625.
Okay, when you multiply this 0.3123. So I don't know where we are getting the 5 from.
You said?
0.3123. It's not 0.23125.
I think it's you know, the 0.8333
33 is short.
is
It's
right there.
333333.
So if you multiply that, it should give you 3125 if you use the total.
Okay.
So now you have weight of short-term debt, and you have weight of long-term debt, and you have weight of equity. So you can now calculate your WACC. So my WACC should therefore be equal to 0.625, which is the weight of equity, times cost of equity 0.145, plus short-term 0.0625 times 0.068 times 1 minus 0.28 plus long-term 0.3125 times 0.035 times 1 minus 0.28. So that gives you your WACC. Any question?
There, please. Oh,
Yeah.
I beg there. You know, at the top, the way you wrote it right, top right corner, where we
Yeah.
look for short-term debt.
Mm-hmm.
The short-term debt, when you cross multiply this one, you get short-term debt is equal to 0.2 times long-term debt.
Yeah.
So now in finding the long-term debt,
Mm-hmm.
it is where my confusion came. Now, long-term debt, to me, should have been, okay, long-term debt, you divide it
By total debt. Yeah.
by total
Yeah,
debt.
Razaka.
Okay.
Was you
Yes.
today?
Isaac, please mute yourself.
So, okay, I get it.
You
It's okay,
get it.
sir. Yeah.
All right. Any other question?
Yeah, so
Yes,
my question,
Joseph.
I think I was a bit, I won't say lost, but a bit somewhere about the weighted um, long-term debt. Why you multiply the 833 by the 0.375?
Yeah.
I wanted to see the notion behind that.
Yes. So what the 0.8333 is
Mhm.
the percentage of long-term debt in our total debt.
Oh, okay.
So now we want the percentage of long-term debt in our total capital. But we have found the percentage of total debt in our total capital to be 0.375.
Mm-hmm.
If you multiply the 0.375, which is total debt percentage, by the percentage of long-term debt in our total debt, then that gives us now the percentage of long-term debt in total capital.
Mm.
But
So,
as at this point, we
mhm.
have not considered equity. We're only looking at debt.
Yeah, that's
Okay.
the percentage of the debt, the long-term debt
In
inside
total debt.
in total debt. That's the
Exactly.
point. Uh-huh.
Yes.
So the weighted long-term debt,
Mhm.
in arriving at it, that's how
Yes, so
was
the
this
weight of long-term debt, your
in
total
the debt?
debt in
Mm-hmm.
total capital is
3.75.
yes.
Uh-huh.
So two people are sharing 375. One is
Mm-hmm.
entitled to 0.833.
Mm-hmm.
So how do you find your percentage in 375? You multiply.
I thought it to be divided
Divided.
You thought it will be divided.
because I think it is
Yes,
inside
I
the
also
point
thought
three
to be
seven five.
divided.
So
Yeah.
as a weight on it,
No, so look at it. So
I,
this is
I'm
why.
not.
No, okay, let me show you why it's not divided.
Okay, so.
You have done the division here. See, it's
Mm-hmm.
LTD over total debt. So
Okay.
you divided it to get this.
Mm-hmm.
Okay. So
Mm-hmm.
now, so what you've done is converted to percentage.
Yeah.
So if the whole is 375 and your portion is 0.833 of it, it cannot be divided. You have to multiply it.
Okay. Okay.
But if this was, let's say, a value, let's say long-term debt was 20,000 and your
Mm-hmm.
total debt was, say,
60,000.
50,000.
Mm-hmm.
Okay, then that one you have to divide.
Mm-hmm. Okay.
But as a start, what we have done is we have rather than, so what we did here to arrive at 0.833 was 20,000 over 50,000.
Okay.
Okay, that's what where we arrived at 0.8333. So now if
Mm-hmm.
I want the 20,000, I have to multiply 0.833 by 50,000 to get the 20,000.
Okay, it's already been divided, so it has to now be multiplied.
Exactly.
Sir,
Okay.
Prince, what the weighted short-term debt?
Yeah.
That's where the 0.375 minus that minus Prince. Can you explain that one for me?
Yeah, so here, from the top here, we say short-term debt plus long-term debt is equal to total debt. So if I know long-term debt, I just make short-term debt the subject. So it will go and subtract.
Oh,
Okay.
okay. Okay.
Yeah. So short-term debt
Okay.
then becomes total debt minus long-term debt.
Oh, okay. Thank you.
Yeah. Any other question? What did you get?
0.1288.
0.1288. So comparing the three watts, what do you think is accounting for the difference? Okay, it says, what is the difference between watts? And then which is the correct watt to use for project evaluation? So the difference between the watts is as a result of the weight. Okay, we use different weightings. And as you can see, the weightings differ across the various sources of financing. And that is what is accounting for the differences in WACC, because the cost of the respective source of financing remain the same. But what is changing is just the weight, and that is what is accounting for the difference. Now, for the question, which of the WACCs is correct for purpose of project evaluation? When it comes to project evaluation, because projects require an outlay of fiscal cash in anticipation of some future cash flows, it is always important to make sure you are using flows that are more objective. Now, if you consider the three sources of capital, three weightings that we just used, the book value is very subjective. But you go to the balance sheet and you pick the values, the historical values as of the time inception, actually. And these values may not be relevant in current situations. So expecting the WACC for purpose of some future project, you cannot fall on a book value weightings because it's subjective. In the same light, the targeted capital structure would have been best if there were some objectivity in estimating the target. Okay, who determines the debt to equity ratio? It is also more subjective. You sit and you say that, okay, I want my debt to equity ratio to be 60%. And I want my short-term debt and my long-term debt to be 20%. It is also subjective. If not for the subjectivity nature of it, and there is a reliable means of estimating a target debt to equity ratio, that would have been the best. Why? Because it looks into the future, and the project you are evaluating also has some future implication. But because of the subjectivity surrounding the estimation, it makes it not appropriate. So comparing the three, the market value weightings is more objective. Because if I have, for example, ordinary equity, I go to the market and find out what is the current price per share. And I multiply that by the number of shares outstanding. It's objective. I can know the current value of, debt. If it's a bond, I can determine the current price of bond using objective means. Okay, so that is more objective, and therefore, for purposes of project evaluation, the market value weightings are recommended, okay, than the book value or the target capital structure. In some cases, you may be tempted to think, oh, let's use the lowest, the one that gives us the lowest. Okay, but if you look at the one that gives you the lowest, you may be overly ambitious for the project or over optimistic. Because just considering the lowest means that the project will deliver a higher value. Okay, but it is because you have been optimistic and have used a lower cost of capital. Accountant, be wise, prudence concept tells us to anticipate losses rather than profits. Yes, Jerry.
Yes, my confusion is that I was thinking we should use the target capital structure because the project is more or less a futuristic project.
Good.
And management will want a certain structure or will use a certain source to finance that project. So I was thinking that management will put in the conscious effort to be able to raise capital from the various sources that will match the target. That is where my confusion is, because the project is something in the future, and this is our target, that we want our capital structure to be in this form. So why use the market weight rather than the target, which is more or less something in the future?
Right. So that's why I said that ideally it would have been best to use the target, given that it's a future project. But it's the objectivity surrounding the estimation of the target. How do you determine that my debt to equity ratio should be 60%? Okay. And this, most often when we are estimating, estimations are mostly done based on historical data, which may have some elements. So you just go to your books and find out in the past, what has our debt to equity or ratio looked like? What has our capital structure looked like in the past? So you go in there, but remember that though the project is going to happen in the future, but the cash flows that you expect to put in the project is a current cash flow. So you always say that if you are evaluating project, look at the future cash flows in today's terms. What is the worth of those future cash flows in today's terms? Because the project requires commitment of cash flow today. So though it will happen in the future, but we want to look at it in current terms. And so the sole reason for opting for market value weightings is because of the objectivity that comes with. But ideally, fantastic. We need to be, the project is in the future. So we need to look at the future target. Until we have settled on that target, it is not objective. And we may not be accurate. But if we use current market values, we know that this is how much currently we can obtain the various sources of capital, and that is more objective. So that is why that is recommended for evaluating the project, because the project evaluation is happening now. It's not happening in the future. Yeah, evaluating it now. Okay, so if I have to take the project, should I go in for it or not? That's why we need to even bring all cash flows, which is happening in the future, to today's term, because the decision has to be made today, and we need to look at the today's implication.
Sir,
Yes.
please, I want to take it back a little to the work. When I calculated, I had 0.0291. So I don't know how come the result here is 0.1288. I don't know if anybody also had a different answer.
I hope you are looking at the tax area. I think the tax area, it takes it out 2 times, so on the long time and on the short term.
Yes,
You
I did.
it.
Is
Yes.
there anybody who also has done it, or you have all copied?
Copy is 90%.
Oh, please, like I told you, you have to get your calculators and also punch some. Punch some and get used to the calculator, because you'll be using it in exam hall. Please punch
Hello,
some.
sir.
Yes, sir.
I also had a different figure from what she's also mentioned. I
What
also
did you get?
had 0.10.
10.
0.1016.
Wow.
16.
Yes, that's also got the same. Yes, sir. I also had the same figure. I was.
Sir, please, let us all recalculate it and see.
It looks like the 1016 is majority. Anyway, majority can be wrong. So please recalculate.
Thank you, sir.
Yeah, so Jerry, are you with me on that?
Yes, please. Thank you. Yeah.
All right. Okay. Please, if you are done, let's make progress. As for the punching, you punch it. Let's look at question 5, the last question on the set. Then we will start with capital structure. It's very simple question. This one, the last time it came, it was just 5 marks. Very, very simple question. Mako Limited has expected earnings of 10 cedis per share for next year. The firm's return on equity is 12%, and its earnings retention ratio is 60%. If the firm's market capitalization rate is 20%, what is the present value of its growth opportunities?
Sir, I still had the same answer,
Okay.
which is 0.0291.
Hey, 02 there is too small.
Please, I
Because
think the last one, the long term distance, I think they are using 0.02 instead of 0.035.
no,
I used 0.035 and I got 0.1016.
no. So opening the Jemima. Yes, even if you multiply 0.625 by 0.145, you will get more than 0.02. So check your computation. The first one is point 0.625 times 0.145. I hope that's what
Yes. Yes.
You can do it one after the other. I think the 0.1016 should be about right.
Okay.
Yeah. Okay. So the Mako question, what is the question asking you to do? When you have a question, identifying what you are asked to do is the most important thing. Then you know how to do it. If you don't know what you are asked to do, that one, you can't do it. So what's the question? What's the requirement of the question? They said, what is the present value of its growth opportunities? So they are simply asking you to calculate price of the firm's share. And this has issues of guarding constant growth. Okay. So you and I know that cost of equity using the dividend valuation model is equal to D1 over price plus the growth rate. So the question wants us to calculate price. It is P naught. And if you make price a subject, price should be equal to D1 over R minus G. And in the question, sorry, RE minus G. In the question, we know RE, which is the market capitalization rate, to be 20%. What is D1? Do we know D1? Please, are you reading the question?
It's 10.
10. Are you sure?
The expected earnings
10 per
per
share.
share for next year is 10. Oh,
But that's earnings. That's not dividend. We
So
were
6.
not giving,
Yeah.
but we were giving earnings
So that should be
per
4.
share to be 10. And we are told retention ratio is 60%. If retention ratio is 60%, then payout ratio is 40%. All right? So if I
Yeah.
want dividend should be payout ratio times
Man.
earnings per share. And that's 40% times 10, giving me 4. So that's D1. What is G?
Go for it.
Yeah, so what was the percentage?
Is it 7.2?
Yeah, how did you get that?
The ROE is 12, and then the retention ratio is 60%.
Good.
So I multiplied the two.
Remember we said sustainable growth rate is ROE times retention ratio. Okay, so that is 0.12 times 0.6, and that's giving us 0.072. So that's your growth rate. So now that you have all information, you can calculate your price to be 4 divided by 0.2 minus 0.072. What do we have? So here, the lesson that I want us to get here is the computation of growth rate. So sometimes you are not given the growth rate, but you are given information that will help you to calculate the growth rate. Then again, the also other thing that is in there is the dividend. You and I know that D1 is actually computed as, so most often what we have known, D1 is equal to D0 times 1 plus growth rate, isn't it? But the question gave us earnings per share for next year. So if you calculate the percentage on that earnings per share, then it gives you dividend for next year, not dividend for current year. So that's why we are not multiplying it by 1 plus growth rate. It gives us straight. So those are the little things you should pay attention to.
Sir, please take it again, the dividend issue you're talking.
Yes. What I'm saying is that ideally you would need to grow the dividend. If it is current dividend, to get year one's dividend. Now, because the question gave us earnings per share for next year, and that is out of that we are computing our dividend. Whatever dividend you compute out of that next year's earnings per share is next year dividend. It's not current dividend.
Okay.
What did you get?
31.25.
31.25. All right. Now let's look at capital structure. Any question?
Hello, sir, please. There is a 4 over what? 0.2 multiplied by 0.075 or plus.
Minus.
Minus.
0. Okay, thank you.
What is capital?
Hello, sir. Sir.
Yes, Jerry.
So is this one the price or the present value of growth opportunity? Because my confusion is that
present value of growth opportunity is the price.
Oh, really?
Mm-hmm. How do you determine price of share? Price of share is basically present value of future cash flows, and the future cash flows are dividend and capital gains. But depending on the behavior of dividend, you can use just dividend. So if dividend is growing at a constant rate, we use the Gordon constant growth model. So if we discount all dividend into present value, add it, that is the price.
My confusion is that if we are assuming that yes, the price of the share is the present value of its cash flow. Yes, we are discounting the cash flows.
Yeah.
Then that is one phase of it. Then the possible growth opportunities of the firm, we are trying to establish the growth opportunities in addition to the cash flows. So my thinking is that the present value of the equity has two components: the discounted cash flow as well as the growth opportunities in it. So that is where my confusion is now. Or I am wrong in that analogy, that the value of the stock is the present value of its future cash flow at one phase, then two, the present value of its growth opportunities. So the cash flows, we've discounted it. Then we are trying to establish the growth opportunities of the firm as well. So the value is in two forms.
Okay.
Or I am wrong with that analogy.
Okay, so let me just clarify that. You see, the growth opportunity would be embedded in the dividend, and that's the feature. So what we can do, given the growth rate, we can estimate the dividend for each of the years to come. But you know that shares are in perpetuity. So if dividend is growing at a particular constant rate, we use the perpetual model. Now, so you cannot estimate the dividend forever. So we use the perpetual growth model. And that is why we actually take the growth rate from the discount rate here. So you said D1 over RE minus the growth rate. Because the RE is the total return expected by providers of capital, equity capital anyways, because what we are doing is for equity holders. For us to achieve whatever growth rate that they expect, they need to give up part of that return. They need to give up some of their expected return. And that is the growth for us to be able to achieve the growth. So you give that up and we use that as our reinvestment need. So if you look at the sustainable growth rate computation, this is the expected return on equity by shareholders. We multiply that by retention ratio, saying that to achieve any growth, you have to give up part of your expected return. And so a percentage of your expected return is the growth that we can give you. And so to discount it, we can no longer use the original return on equity computed. We need to give up part of that return so that we can achieve the growth. So what you are saying, the growth opportunities and the cash flow, we have actually taken all into consideration, and that is what is giving us this current price. If we seek to achieve a growth of 7.2% year on year in perpetuity, then this is how much the share will be worth.
Okay, so wouldn't the question rather be more clearer if it were just to say you find the price
If they
or
say
the return of
find the price, that one is financial management. So the wording of the question is advanced. That makes it advanced financial management.
Anyway, all right, thank you.
Yes, in financial management, they will ask you calculate the value of the shares or calculate the price. But advanced, you have to be present value of growth opportunity. That is advanced. When you are speaking at that level, you use that growth opportunity, like huge jargons. But essentially, what you mean is price. And
all right, thank you.
that provides more meaning, more intuition. Okay, that if you understand really the Gordon growth model, then you know that, look, whatever price I'm calculating is actually the growth opportunity. Because for me to achieve any price of this nature, I need to be growing at this particular rate. And shareholders should be willing to give up this kind of percentage of their return so that we can achieve that growth for them. Good. Capital structure and valuation. When we talk about capital structure, but before that, do you need some 5 minutes break? Good, good. Let's continue. So, capital structure, we say, is the mixture of debt and equity a firm uses to finance its activities. Now, what we want to see is that what we want to do here, beyond determining how do we finance our business, we want to go further to look at the impact of the capital structure on firm value. Remember, we said as a financial manager, one of your key decisions is to make financing decision. But for every decision you make, you should make sure that the decision is going to lead to maximizing shareholders' worth. That is established. And for every decision you make, you should be thinking of that. To maximize shareholders' worth, we said that we are increasing dividend or we are increasing share price that will lead to increase in capital gains. So this is our focus anytime we make decisions as financial managers. So when it comes to capital structure, you want to look at what combination of debt and equity can I use to achieve a better growth for my shareholders? Should I use debt? Should I use equity or a combination of the two? Now, if I'm increasing my equity, what is the implication? You and I know that if we increase our equity beyond and it does not translate to higher return, we will be diluting earnings per share for existing shareholders. Is that good enough for shareholders? Is that in the best interest of shareholders? That is no. If we are also introducing debt, what is the implication of introducing debt to your equity holders? As you introduce debt, financial risk increases, risk of bankruptcy increases, a risk that shareholders will lose their investment also increases. Is that in the best interest of your shareholders? So then, how do we determine the optimal level so that our shareholders are okay? The optimal capital structure, the point at which we're able to maximize the value of the firm. There's been several theories of capital structure. Most of these theories speak of whether capital structure is relevant or is irrelevant. And chief among them is Modigliani and Miller. Okay, the Modigliani and Miller, they have a capital structure irrelevant theory. Okay, and for them, the first time they make a proposal, their proposal is based on a perfect world, in an efficient world, in a perfect world, where investors are seen to be rational. They will always take on additional risk when there is perceived additional return. Where there is no taxes, where information is available to all, there is no information asymmetry. Both firms and individuals can borrow at the same rate. There's no variation between the interest rate at which parties or economic agents can raise capital. So if I'm an individual, I go to the bank to raise capital, the interest rate I'll be given is the same as if it's a corporation that went to the bank. That is the assumptions that they made. You and I know that that's not true. Because for individual, the risk of individual is higher than risk of a corporation, and therefore corporations will most likely get a lower interest rate than an individual. But in a perfect world, we should all get the same rate. So they made certain propositions that, look, the value of the firm, one, is not simply the addition of its capital structure component. So if my capital structure is made up of debt and equity, if I want firm value, Modigliani and Miller says that firm value is not D plus E. It's not simply addition of its capital structure component. And even if it is, then irrespective of the kind of percentages that you use, the capital structure will not change. So like the pie theory, if I have this pie, this is the whole. Will the size of this whole change because I have divided it into two equal parts? Or will the size change because I have divided it into one portion, maybe 20% here and 80% here? The size will not increase to this, neither will it decrease to this. it will still remain the same, irrespective of how you slice this pie. Meaning that irrespective of how you structure your capital, the percentages that you use, the value of your firm overall will remain the same. So whether you use 30-70, 20-80, 40-60, 50-50, 10-90, it is still 100%. So capital structure is not going to have any impact on the value of the firm. So according to Modigliani and Miller, your capital structure is independent of your value, your firm value, because firm value, so from their proposition 1, they say firm value is basically the present value of the future cash flows of the firm. So if I want firm value, and I assume that this firm is going to have a constant cash flow, and given that is the value of a firm, and the going concern concept that firms are going to exist for a foreseeable future, I'm not expecting that cash flows will change. So constant cash flow in perpetuity, then I can determine the value of the firm as present value of its future cash flow using the perpetuity model. That's cash flow over the weighted average cost of capital. My discount rate is WACC because I am using a combination of debt and equity to finance the project. We have done that not long ago, so you know that. So the argument that they made is that, look, if the capital structure does not impact any of these factors of determining the value of the firm, then the value of the firm is independent of the capital structure, as you can see. So that's your proposition 1. Then they went further to see that, so we saw that, look, to some extent, in a real world, so they came to another word we call world with taxation. So world without taxation, that is the perfect word we spoke about. Value of the firm is independent of the what is it called? The capital structure. So which means capital structure has no impact on firm value, subscribing to the traditional empire theory. Then when you come to their next research or paper, they incorporated taxation. That if we live in a world with tax, when we introduce debt to our capital structure, that may likely have certain impact on the value of the firm. But even that, they made 3 key scenarios. Okay. They said that when we introduce debt in our capital structure, because of the tax deductibility of interest on debt, we are likely to see our cash flows go up a bit and our cost of capital reducing. So in that sense, one would expect that it would impact the value of the firm. So the first scenario is that if you introduce, debt, your cost of equity would increase, but it will not increase to a tune as your cost of debt decreased. So that is equity holders will respond when you introduce that to the capital structure, but their response will not be exactly up to the reduction in cost of debt. So in that sense, the value of the firm is likely to increase because your weighted average cost of capital will reduce. Then there is the second scenario where they say that, look, if we introduce that today, equity holders will realize the exact risk that they are facing, and they will demand a return exactly to offset the reduction in cost of debt. Remember, we said that because of the tax shield, the interest deductibility, the tax deductibility of interest, your cost of debt will reduce by the tax shield. So that reduction will exactly be offsetted by an increase in cost of equity because equity holders will require additional return. So it will be the same. So if it's the same, then it means that the value of the firm will not change. It will also remain the same. Then the third scenario that they also mentioned was the equity holders will demand a return higher than the reduction in cost of debt. If that happens, it will have impact on the value of the firm. Okay, so those are the scenarios. So in their second proposition, they said there is a positive relationship between gearing and cost of equity. So as financial risk increases, you would expect that the return to equity holders will also increase. So for them, once you add debt to your capital structure, you need to recalculate the required return to equity holders. We call it the geared return to equity holders. So your RE, if we introduce debt, now becomes RO plus debt to equity ratio times RO minus RD times 1 minus T. This is in a word of taxation. So RE here is the geared cost of equity. Or the levered cost of equity. Geared or levered cost of equity. Okay, so take note. When capital structure is changing and we are introducing debt to our capital structure, we should be able to look at the impact of that on the cost of equity. And RO here is the ungeared cost of equity or unlevered cost of equity. So that is the return to equity holders when the firm was all equity financed. But as soon as we introduce that, we need to recalculate that to now get the return to equity holders when now the firm is geared. RD is cost of debt, which you are aware. T is tax rate. D, value of debt. E, value of equity, debt to equity ratio. So this is the proposed model to calculate your geared cost of equity by Modigliani and Miller, given that our capital structure is changing or we are introducing debt to our capital structure. Any question? So when we do this, we have showed the impact of risk, okay, financial risk on the business. Now let's look at the impact of capital structure on CAPEM. Okay, on CAPEM. Same computation of cost of equity. So we have said that according to CAPM, RE is equal to RF plus beta times RM minus RF. This beta, we said, is a measure of systematic risk. Now, when we introduce that in a typical business or in a typical firm, we know from your accounting equation, asset is equal to capital plus liability. So if the firm is all equity finance, then it means the firm's asset is equal to capital, isn't it, or equity? All right, that's all.
Yes.
But when we introduce debt, then it changes the scenario. So if the firm is all equity finance, its beta is deemed to be the asset beta, because once it's all equity finance, then it is the asset beta of the firm. So we can say the asset beta, I'll denote that by beta A, is equal to equity beta, beta E. So beta A here is called the asset beta or the ungeared beta or unlevered beta. And this is the beta of the firm when it is all equity financed. As soon as we introduce debt to our capital structure, your asset beta will now no longer be equal to your equity beta. So this is equity beta raised to equity holders, systematic raised to equity holders, also known as a geared beta or levered. So as soon as we introduce debt, now your asset beta becomes the proportion of equity beta plus proportion of debt beta. Because before introduction of debt, your firm was 100% equity, and therefore your asset beta was equal to 100% debt beta, equity beta. But as soon as you introduce debt, now you have to calculate the weighted average of the betas. So your asset beta now becomes the value of equity, so equity over equity plus debt times your equity beta plus, but we know that, interest on debt is tax deductible. And so here you multiply your debt by 1 minus T, okay, times equity beta. So that is the proportion of your equity beta that contributes to the total asset beta of the firm, plus the proportion of debt beta, D over A plus D, 1 minus T, times debt beta. Now, we make certain assumption here. We assume that in the long run, the beta of debt will always approach 0, because once you owe debt, no matter what, you pay debt. So the risk to debt holders in the long run will approach zero, because even at bankruptcy, debt would be defrayed. We will sell off our asset and pay off our debt. So debt always gets paid, and therefore the risk debt is presumed to be a default-free instrument. You are not likely to default on debt. So BD then becomes, beta debt becomes zero. So if beta debt becomes zero, then your total here will all be zero, isn't it? Are you following?
Yes, Kingsley.
I hope you are not sleeping. No, it's 6:22. Wake up.
Yeah, awake.
Good. So if that becomes zero, then what it means is that now your asset beta is equal to equity over equity plus debt, 1 minus T times your equity beta. So when we introduce that, what we actually want is the equity beta, and that is why we say you should calculate the geared beta or the levered beta, because once you introduce that, the risk to equity holders will increase. So you want to know, from what we started from, when the firm was all equity finance here, all equity, asset beta was equal to equity beta. But as soon as we introduce that, asset beta will no longer be equal to equity beta, because the risk level to equity holders will increase. Financial risk, risk of bankruptcy, okay, they will all increase. So you need to now determine the risk to equity holders after introducing debt, and that is what we call the geared beta or levered beta. So let's make BE the subject of this equation. How do we do that? From this, we can say that asset beta we can multiply, okay, cross multiply by equity plus debt, 1 minus T. This is equal to E times equity beta. I hope that's right.
Yes,
This
Kingsley.
is multiplying, so this comes to multiply this, and then this also goes to multiply that. So that's what you have. Now, since we are looking for equity beta, we can divide through by E. So we can say that, so that's what we have. We have beta of equity times E is equal to asset beta times equity plus debt times 1 minus T. So that's what we have. So now we divide here by equity and divide here by equity. So we have as equity beta to be equal to asset beta times, now this will be E over E will give you what? 1, right? Hello?
We are following.
So
Yes,
E over
E
E
over
gives
E
you
is
1
1.
plus D over E times 1 minus T. So that gives you your equity beta. So now, if we want to calculate cost of equity when gearing is introduced, a capital structure, we introduce that to a capital structure. Now, CAPM RE should be equal to RF plus, now is no longer beta asset, but rather equity beta times RM minus RF. So this is computation of the geared cost of equity. So depending on the information you have in the question, you can either use this if you have issues relating to CAPM and the capital structure is changing. You have to determine your geared beta and use that to calculate your cost of equity. But where you have information relating to ungeared cost of equity, we use Modigliani and Miller's model to calculate the geared cost of equity. Any question? Any question? So that is the impact of gearing on cost of capital. Hope you can see. Of course, there are other capital structure theories that I'm sure you are aware of, that you did it under financial management. Okay, we have signaling theory, we have the static trade-off theory. Yes, Victoria.
Sir, please, when do we use the Modigliani and Miller approach?
It's depending on the information in the question. I'll show you sample questions very soon.
Okay, thank you.
Depends on the information. So if you don't have information relating to CAPM, like beta, risk-free, and what have you, then you don't use CAPM. But where you have the firm, so you notice that, okay, let me just show that. But if I leave here, I'll lose my write-up. So we have to start. Okay, so no problem. Let me show you the question. Two different questions. Okay, so if you look at question 5 here, do you remember this question?
Yes, sir.
Yes.
Yes. I solved this question with you in the main class.
No.
When?
The second time Prof. Kofi asked me to teach online, I did a question like this with you. But don't worry,
No, sir.
we will go through.
Okay.
Now, the Jed Manuel Limited is a conglomerate and is considering 3 potential investment projects for which it is assumed they have sufficient funds. The relative risk of each project has been assessed and the beta for each project is given as below. Engineering 2.2, sportswear 1.1, water utility 0.6. Now, the question says the company's financial structure is presently 70% equity and 30% debt. The cost of debt is 8% and the cost of equity is calculated using the capital asset pricing model where the industry average asset beta is 1.2. The risk-free rate is 6% and the market risk premium is 8%. The corporate tax rate is 30%. The financial manager has provided the following estimate of after-tax cash flow for the 3 projects, which are assumed to have equal lives of 5 years. Now, calculate the benchmark cost of capital. Using appropriate cost of capital for each project, evaluate the viability of these 3 projects. So let's assume you want to calculate the cost of capital or cost of equity. You see that the information here suggests we should use what? CAPM. In fact, they said it. Cost of equity is calculated using the capital asset pricing model. And you are giving average asset beta to be 1.2. You are giving the respective betas of the respective projects as 2.2, 1.1, and 0.6. Now, in this question, do you have to calculate a geared beta or not? What do you think?
I think you have to.
Why?
Because of the debt component in it.
Good. But the fact that there is debt component does not mean you should calculate a geared beta, because the firm is already geared before this beta. So this beta here is a geared beta already. All the betas here are all geared because that is the financial structure of the firm. But if you were given a beta before we introduce debt, so you need to know the difference. If the firm was all equity, and then when it was all equity, had a beta, then now we are trying to introduce debt and want to determine the impact of introducing debt on the firm. That is when you have to gear up. But this one is already geared company. So the beta you see here, though the question is the asset beta, is a geared beta because the financial structure they say presently 70% equity and 30% debt. So in this case, you do not gear up. You use the betas as you are given because the firm is already a geared company. So each beta is a geared beta. I hope you are getting what I'm saying. Now, if you compare this to this one, this question here. If you read the intro, Laidlaw, an ungeared firm, means the firm is all equity, has expected earnings before interest and taxes of 2 million a year. Laidlaw's tax rate is 30% and the market value is V is equal to E, 12 million. So you see, their total value is equal to total equity. The stock has... Hello, can you hear me?
Yes, Kingsley.
When the thing was getting interesting, then the network took it. Okay, where did I end? Did you hear me reading the
We
question?
went to the
Yes,
we
but
started reading the ungeared
Yes.
firm question. Yeah.
So Laidlaw, an ungeared firm, has expected earnings before interest and taxes of 2 million a year. Laidlaw's tax rate is 30% and the market value is V is equal to E, 12 million. The stock has a beta of 1.2. So this beta, is it a geared beta or an ungeared beta?
An ungeared beta.
Yes, because the firm is an ungeared firm. So this is an ungeared beta. So if you come down and they tell you that, hey, calculate the cost of equity when debt is 3 million and when debt is 9 million. Now, because in here they tell you that, where is it? Management is considering the use of debt. Debt would be issued and used to buy back stock and the size of the firm would remain constant. So we are now thinking of introducing debt. So if we introduce debt, then our risk to equity holders will change. And that is where you have to now go and calculate a geared beta. So say calculate cost of equity when debt is 3 million and when debt is 9 million. If you have to calculate cost of equity, you have to make sure you gear up your capital structure. You gear up the equity, because the equity you have here is an asset beta, an ungeared beta. So given that now we have introduced that, we have to calculate the geared beta. So please take note of the two different scenarios. A scenario where the firm is already geared up and you are given a beta, that beta is already geared. But if the firm is not geared and we are now thinking of gearing it up, then you have to make sure you gear up the beta. Any question? Okay. So if you look at this question 2, question 3, Mojito Limited, that this question is a perfect example of Modigliani. So if you look at it, the B part, it says, what is the required return on the firm's levered or geared equity? Now, if you look at this question, there's no beta anywhere, there's no risk-free anywhere. So it means to calculate that expected required return on the firm's geared equity, you have to use Modigliani and Miller's cost of geared equity capital. So that's what you have to look at the question, look at the information in the question, and that should help you determine what to do. Any question?
Sir, please.
Yeah.
Can you go over the question again, please?
This particular one?
Yeah, like for better understanding.
Yes, so what I'm saying is that if you look at the information in this question and they ask you what is the required return on the firm's levered or equity beta, you can see that from the information here, there is nothing about risk-free, there's no beta, there's no market return in there. So you can't use CAPM to calculate that. But you are giving, Mojito has a debt to equity ratio of 0.45. Required return on the company's unlevered or ungeared equity is 17%. Okay. And now they said you should calculate the required return of the firm's levered or equity, levered or cost of equity. What I'm saying is that, so in this particular case, you have to use the Modigliani and Miller's cost of equity approach because the firm is an ungeared firm and want to determine its geared cost of equity. The next time we meet, we will solve the questions, but I want you to go and practice them. Look at it to see if you can do it. The next time we meet, we finish on capital structure, and then we will continue with measures and acquisition, another interesting area. All right. So that will be all for today.